Welcome to another episode of the Blue Fort Blueprint. My name is Siddhant and I'm joined by Viraj and Sayam like always. Today we're going to be talking about the complexities of investing in the stock market directly. In a time since I think March 2023 where the markets have been in a complete bull run, almost everyone seems to think that they can invest in the stock markets, and almost everyone seems to be oversimplifying how to invest in the stock markets, right? However, we want to remind you that this party does not last always. And there are some specific events and some specific examples we want to take where things can get a little tough, right? Things can get a little harder. And as an investor, you should be prepared. So one example I would start off with is Kotak Bank, which has been a bellwether of investors for decades. I think RBI unexpectedly announced some restrictions on Kotak Bank, because of which it corrected significantly, right? And investors are left in a tizzy. They're not sure what to do, and brokerage is also saying that this might affect profitability significantly. Now, while it's not appropriate to react on every single market event, but it's important to understand which one to react to and which one to not, and how it fundamentally affects the stocks, right?
The market is extremely dynamic, right? Things are constantly changing. No matter how well researched you are today, things can change drastically in the future, whether it be positively or negatively. You gave an example of a negative, something that happened negatively. Something that happened very positively is the example of Zomato. How recently Goldman Sachs came out with a report saying that their acquisition of Blinkit, the Blinkit business, is now more valuable than Zomato's original food delivery business. And honestly, no one was expecting that. Back when 2022, when that acquisition was made, every single person, including Goldman Sachs, thought that this is a horrible decision. What they've done is going to go horribly wrong, and they're just burning money. And it turns out that has actually worked out so well that it is what's driving Zomato's profitability now, and it's transformed the business from a food delivery business to a bigger play that is e-commerce. That is why the stock price from 60, it has now gone up to 190s. It's tripled in the time since they've made the Blinkit acquisition. So the point being that a lot of times consensus can be very wrong as well. A lot of times what you're expecting, something else can entirely play out.
But what do you think went right with Blinkit? Because I remember initially we had a chat and you said that this is a horrible acquisition and you're more of the equity research guy, and even you thought it was bad. Obviously, you need to be a little more on top of your research. But what do you think went right with Blinkit? How is it that it suddenly turned around?
Two things. Number one, the market size for grocery delivery is much larger than food delivery, right? And now it's no longer just grocery delivery, it's e-commerce in general. They're selling everything you can think of. They're selling headphones, they're selling mobile phones. If you remember, we got our India jersey during the World Cup from one of these quick commerce
I think they have
platforms.
a PS5 in 15 minutes delivery as well.
PS5?
Yeah.
Who has this?
Blinkit.
Really?
They have PS5 in 15 minutes.
How are you supposed to pay? People are paying with their credit cards.
No idea. I don't even know who has that urgency of wanting a PS5 right
But
away.
that's the thing. The credit to them, they've created that habit.
Fair enough.
Right.
If you remember, none of us ever, 3-4 years ago, we didn't ever need anything in 10 minutes. Now it's the norm. Now all of our groceries come that way, right? So that is one. They've expanded the market. Number two, execution. They have killed it in execution. They now have the largest market share. Me as a shareholder, I'm sitting very happy, honestly. Even though I didn't expect it, the share price has gone up and it's worked out tremendously well.
The point you made initially about investing in stock markets and how particularly stocks has been difficult to pick, and even stocks like Kotak Bank, which you mentioned, has been correcting 10%, 8% since some news coming in, right? I personally believe what Sayyam mentioned about the dynamism. So back in 90s, back in 2000s, the dynamism wasn't that much, the participation wasn't that much, which made us to believe that, ये 10-15 स्टॉक पकड़ लो, आप रिलायंस ले लो कुछ नहीं होगा, आप कुछ और ले लो कुछ नहीं होगा, and ये लंबे शेयर पकड़ के रखो, you're bound to make money, which may not be the case right now because of so much liquidity coming in, so much information coming in, so many people coming in, right? Not very far
Technology
off.
is also a big part.
Technology is a
New
big part.
technology it's difficult to understand how it will disrupt existing industries.
Exactly.
So the cycles of businesses are getting shorter.
Even something like an HDFC Bank, which is
Yeah.
supposed to be like the god stock, कि इसको कुछ भी नहीं होगा, इसको पकड़ के portfolio में रखो, you're bound to make money. I think that fell by 9% in a day.
Right.
So, and nothing is shielded, to be very honest. Your listed stocks, your foreign stocks. We've done this podcast where we've spoken about Netflix and all these Meta shares falling by 20-25%, right?
Not 20-25%. Netflix fell by 70%.
70% in a day, correct, exactly. And this is where our markets are also moving. So it's not like bas badi company hai, achhi company hai, to kuch nahi hoga. Every stock is, of course, I would say, open to that much of a correction and open to that much of an uprise also in the prices.
Another example that we have seen recently with a lot of our clients is Reliance Retail. How people bought it in the private market thinking that Reliance ki company hai, it's going to do well. And then can you elaborate on what happened?
I believe Reliance's retail's journey as a share price and how Blue Fort started, right? It coincides to a certain extent in a way that what happened was when we started out, it was around 600, 650.
Right.
A lot of these clients wanted it, but at that time there was no fad, or I would say there was no trend of unlisted shares. People were sticking to their guns and everything. I think after COVID, this entire unlisted shares, NSC, Reliance Retail and so many more, right, came into the picture. So during that COVID, if you remember, Mukesh Ambani, left, right, center, I think there were memes also wherein everyone is just at their home, but this guy is picking up money from Google's and Microsoft's, and everyone wanted to invest in Reliance, right? And especially Reliance Retail. So the valuation rose up to 2200, 2300. The recent transaction before their announcement came in was as much as upwards of 3200.
Right.
And suddenly one day out of nowhere, Jio comes in, or Reliance Retail, the management comes in and says like, you know what, we feel that the price is appropriately valued at 1350 or 1362. And whatever you've done till date is gone.
Yeah.
Right. I remember that time getting so many calls because our clients have purchased. Fortunately, most of our purchases were in the range of 1200, 1100. But still, yeah, you're holding for 2 years and you just made $100 on a share. So it was a learning for me as well, how regulatory risk or a management risk in this matter for Reliance Retail can lead to this unpredictability. बस पता ही नहीं यार, उनको लगता है 1350 है तो 1350 है. You can't help it.
If we're saying the markets have become more dynamic than before with emerging technologies and various new variables coming in, right? Does that mean that the days of just buy and hold are over? Because you mentioned, initially that it was as simple as that, right? You just buy the 10-15 names, maybe the leaders in every segment, and you can just forget about it. But now we're seeing some big stocks correct. The ones which seemed untouchable, come down 20%, 25%, 30%, or if they've not come down, they've just not gone anywhere in the last 4-5 years. Also, there's plenty of names like that. So those buy and hold days are gone or what?
I don't think so. I think buy and hold has to stay. But there's an important aspect that is missed out when people just say buy and hold. I think it should be buy and hold and monitor.
Right.
Because if you're not monitoring, you don't know what's happening in the business, it's very possible that something goes wrong. So you definitely should buy and hold for the long term. Your intention to buy should be the long term, but you should also monitor it. And of course, stick to the very basic principles of risk mitigation. Diversify your portfolio, right? So that no matter what happens, whether positive surprise or a negative surprise, make sure that it doesn't impact too much of your portfolio at the same time. And if you don't believe you can do that, if you don't believe you can monitor each and every stock that you're holding, and if you don't believe that that diversification is very easy, just give it to a professional.
The problem, Sayyam, I think, is that people have very different definitions of what monitoring means. Because people think that if they've read something in a newspaper, which is common knowledge, I'm monitoring the stock. Abhi NSC ka itna zyada craze chal raha hai. They've announced
I wouldn't be surprised if one day they just come and be like, you know what, ye sab price to meri 2000 hi hai, tum 4000 pe kharida hai to aapka.
No, so there's clients and there's friends and family who was coming to us and telling us that NSC is the largest stock exchange in the world. Abhi unka profit yahi ho gaya, abhi itna का contract कर रहे हैं. So this for them is monitoring, right? I would say in general you should assume that whatever you know as a layman, the whole market knows, and therefore you don't have any added advantage. You can only really make a profit if there's something you know that others don't know of, right?
Correct.
If you know there's something others don't know, then if you know something that others know as well, typically you will not be able to make any sort of profit off of it.
Even in NSE, right? If you remember, this particular scam came up. It was like
the
a
co-location scam.
Wherein the CEO was kind of referring to some sage in the hills or in the Himalayas, and they were taking advice from them on how to run the business. This is NSE we are talking about, the National Stock Exchange, which apparently is immune from everything else, right? And imagine a guy in the Himalayas in his shorts kind of dictating how this works. Right? So what I mean to say is, and this is something you will never get an information of until and unless you know the CEO or you're in that meeting, right? So it's impossible for anyone to know. It's about understanding where you are getting at, what time are you getting at, and why are you getting at it. right?
Correct.
If you're buying HDFC stock just because your friend has bought it at some level, it doesn't make sense at all.
Yeah.
तुमको लगता है कि ये time पे there is something happening in it which will lead to the share price increase. That's a separate story. But just
Right.
because someone else has bought it or ये कर लो, तो it doesn't make sense.
People think their understanding of a particular industry or sector is and versus what's really happening. Let's take pharma for example. People are like कि अरे यार COVID है तो pharma तो अच्छा ही करेगा.
Correct.
But pharma is so nuanced. It's
Yeah.
so complex. Right, and there's within pharma and healthcare, there's so many different kinds of companies. One is my basic knowledge. One is the diagnostics, like Dr. Lal, and
Right.
which are the other SRL and
APIs
all of
होता
that.
है.
Correct, and then there's guys who are making APIs
Correct.
only, and then there's guys who are manufacturing generics, and each have the different regulatory problems, and each one is getting notices from different authorities, and then the results and all of that, and the kind of drugs then they make. If you really want to get into pharma, you have to understand what drugs they're making, what diseases are developing at what pace. That's the kind of work that analysts do to understand a particular industry, and people like us generally we just say कि यार COVID है तो this will do well. That's our
honestly,
monitoring, or that's the level of research we have.
Honestly, at that time, chala bhi tha. At that time, if you remember, there was a big rally in pharma
Correct.
during COVID.
But nobody really made money in that
exactly.
rally.
Now
Yeah.
that you talk about it, people who still hold those pharma stocks or funds or whatever that
Correct.
is, they have underperformed their peers by a margin.
Right.
Because wo rally, I think it lasted for 6 months.
It
1
fizzled
year.
out very quickly.
Exactly. 6 months, 1 year, and then they've never caught up.
Yeah. So to answer your question, what is monitoring exactly? Everyone has a different definition. It's very subjective. What I can tell you is what the institutions are doing, what the analysts at mutual funds or different investment firms are doing. They're reading the annual reports for the last 10 years. They're meeting the management. They're reading the annual reports of all the competitors or anything, global companies as well. They are doing channel checks. They're speaking to dealers. They're going to plant visits. That is the kind of monitoring that they're doing. So it's safe to say that if that's not something you can do, which most people can't, then your level of monitoring is definitely way below than what the market is doing.
There you go, folks. Basically, what we're trying to say is that while investing in the stock market can be done directly, it's not so simple, right? Or it may be simple, but it's not easy to execute, right? That's what we're trying to say. If you don't like giving your money to professionals, for all I care, just give it to an index fund, just give it to Nifty and Sensex. You'll probably be much better off, right? I think today one more thing we wanted to talk about is recently there was the Berkshire Hathaway AGM, right? And it just struck me that Charlie Munger is not with us anymore, and Charlie Munger personally has played a big role in my life, I would say, or in a lot of our lives. And what I tell everyone when people often ask me what books do you read, who do you consider as your investment, mentors, or who do you think we should be following, the only names that I think consistently will be there is Warren Buffett and Charlie Munger. Literally nobody else, because they're the only ones who have never been wrong. Everybody else has had their moment or shine, sort of moments to shine, where they've come in, they've got a particular call right, and they've made a lot of money, and then they've gone back down, right? But these guys are the only one who have been consistent in what they're saying. They've said the same thing for years. They're some of the wealthiest guys, some of the most humble guys I know. So Charlie Munger, his contribution to Berkshire and the learnings that we can get from him is something that I wanted to discuss. What are your thoughts on him? What is it, how has he played an impact in your lives?
Charlie Munger has, we can all say that Charlie Munger has had an impact on the investing world in general. But I think not many people know that he actually had a huge impact on Warren Buffett himself and his style of investing. So the investor that Warren Buffett is today is because of Charlie Munger. What Warren Buffett used to do was invest in companies where he saw was value. He used to invest in decent companies that were really cheap. Charlie Munger came in and explained to him or showed to him why it makes more sense to invest in companies that are great. Invest in great companies at a fair value. And the word that they used is moat. So that is when he started investing in companies and looking at the quality of the company more than the valuation. And that is what has made him where he is today.
Yeah, Warren Buffett started with it's called cigarette butt investing.
Cigar butt investing.
Basically, where you, irrespective of the quality of company, you buy something really cheap and then you churn it for a quick profit, right? But in its true sense, that really doesn't show what value is, right? I think Charlie Munger really, in the truest sense of the word's definition, showed Warren Buffett what value really means, right? So you can buy something really expensive, but if the growth is tremendous and it's a high quality company, then why not buy it? And it's people don't recognize this, right? Which for Warren Buffett gets a lot more fame and a lot more credit, but it's actually Charlie who changed his entire outlook, and Warren became the investor that he is. Simply because of this. Another thing that people think is because Warren Buffett is worth, let's say, $100 billion and Charlie was only worth $2 billion, there's some significant difference in their wisdom, or there's some significant difference in their ability. But what a lot of people don't know is that Charlie actually gave away most of his wealth at a very, very early stage, which Warren did not do. So he actually gave away $500 million the moment he had made it. So he never got to compound the wealth the same way that Warren did.
And I think Charlie Munger, his legacy, right? One of the biggest legacies I believe he has is every person in the financial industry, no matter in India or in the Western world, wherever it is, has to put his quote on LinkedIn when they start out, right? So everyone does that. So that's a big testament to him. But not only that, right? As you mentioned, the kind of person he was, the kind of the culture that he created, right? You mentioned about 100 billion and 2 billion and all of that, right? But he was a man so above envy, which he's mentioned also multiple times, right? That envy is the biggest sin a human is making, because that's the only sin where you will be most unhappy than the others, right? And he always believed in living a mediocre life, living a way that, you just be a good
mediocre,
person. Simple life, yeah. Just be a good person and just don't do mistakes what an average person is doing. So I think this was one of his very famous quotes, which I personally love, is that you don't always have to be brilliant. Just be more wise than an average person for a very long period of time.
Correct.
So that entirely is so accurate right now.
Yeah, he said that I would rather work with somebody who has an IQ of 120, but he thinks he has an IQ of 110.
Right.
Rather than work with somebody who has an IQ of 180, but they think that they have an IQ of 200. So he placed a lot of importance on integrity, attitude, how hardworking the person is,
consistency,
and how consistent, and basically honest the person is. Right?
He went as far as saying that compounding is the eighth wonder of the world.
Yeah.
Because that is really the biggest wealth creator over anything else. Just
and
patience.
These things are very true today, considering we see these new products coming in so much. As we just spoke about the buy and hold and everything, right? Where people's attention span has become so much lower. That's when these things come into the picture. The person who will eventually win is the one who kind of holds his horses for a longer period of time, and tries to drive away all the noise which he has around him.
And again, one of biggest contributors to that Warren Buffett and Charlie Munger have given us is they've always said this thing called circle of competence.
Yes.
That's the biggest learning that again I've taken as an investor, which means that whatever you understand, invest in that. Whatever you don't understand, don't invest in that. So people don't know again that these guys have actually not invested in almost any tech companies. Even in Apple, they invested very, very late, recently. If I'm not wrong. Because they did not understand the product, they did not understand the technology, they never invested in Apple. They never invested in Bitcoin. They've not, even right now, if you see Berkshire Hathaway's holdings, they've not invested in most of the Nvidia nahi hai unke paas. And you know what? They're still the richest people in the world, not having invested in Nvidia and all that. Now, a lot of people ask me about Nvidia and, semiconductors and this and that. And we're having pretend conversations like we understand. But who the hell understands what semiconductors are? Let's be honest. Who the hell understands what chips are go into which component and what exactly do they do and how that they make the processing better and there's probably a handful of people in TSMC who understand what product they're making. Yeah. So why do we have to pretend as a whole as if we understand, more? We can invest in simple companies. Yeah. All you have to do is go to the mall and see who's buying what. All the girls are going to Zara.
Correct.
Right? Trent runs Zara, right? Which is a Tata listed company. Now go and see the stock price of Trent and how it's done. Where do you see people eating? At the food court. They're eating at KFC. They're eating at McDonald's. These are also, by the way, owned by listed companies. Correct. People are drinking Coke, Varun beverages. These have been huge wealth compounders. All you literally have to see is look around you and see that, okay, this is what people... हमको कोक एंड बर्गर्स तो समझ में आता ही है ना यार. That's all you have to do to make a ton of money.
You spoke about the circle of competence, what they understand. The amazing thing about these guys was that they kept on increasing that circle. They were such avid readers.
Yeah.
Charlie Munger also, especially. He used to read about anything and everything. Every industry, he would try and build more and more understanding. And I think it goes back to that same thing, that curiosity is an extremely important thing to have. for any investor and for any person in general.
Yeah, I think I read this book called Influence, which is Charlie Munger's #1 recommendation. I've told you guys also to read it, but you haven't. I think either of you. But basically, it teaches 6 principles of persuasion, which is, I would argue, the biggest asset to have as a professional, right? How to persuade people, how to become a better professional. I think it's a life-changing book. I would still urge you guys to read it. And anyone who's watching this, if Influence by Robert Cialdini is something that you guys can read, it's probably one of the best works of literature that you can do. So we just have one more interesting segment on today's episode. We get a few questions on our episodes, and we thought we'll do a little Q&A of the questions that we've got from people. So I think, Sayam, you've got a list of questions.
Yeah.
Feel free to ask us, and we'll try our best to answer.
So Siddhant, after the last episode that we had, a frequent question that we got, we spoke about mutual funds, the mistakes that we do in mutual fund portfolios. But what's the right way to go about selecting a fund? What are the factors to look at when selecting a mutual fund to invest in?
Yeah, so, I would like to actually bring it back to Charlie Munger, because he, again, has the answers to everything. And he said, when you don't know the solution of a problem, invert the problem. Right, that's one of his biggest learning. He said this in multiple occasions, in multiple AGMs, actually. Invert the problem. So if somebody asks you which stocks to invest in, he says, what I would ask myself is which stocks to not invest in, right? Or find a reason to not invest in the stock. So selecting something in the investment, world, I think is similar, right? What I would tell everybody is, instead of focusing on which funds to invest in, focus on what not to do, right? Because usually in life, it's obvious what the garbage is. And once you figure out what the garbage is, the whatever's left, you can pick anything from that, and the results would be very similar, right? So there are some basic categories, or there are some basic themes that we've identified in the mutual fund space that people should generally stay away from. Last time we spoke about NFOs, right? So stay away from NFOs. There's certain category like thematic categories, right? Again, we spoke about the complexities of investing. Thematic funds are funds which invest directly into particular sectors, right? So, for example, an infrastructure fund or a pharma fund or a tech fund or an IT fund. It's difficult as an investor to understand which sectors to invest in or time the right sector. So you should stay away from that. Generally, you should stay away from funds which are hybrid or balanced in nature, because asset allocation should be a personal investor choice and not outsourced to a fund manager. It should be based on your objectives, right? Large cap funds have become quite irrelevant because they don't manage to beat the benchmark, which is Nifty and Sensex anymore, right? So these are and then close-ended funds are, again, something that you should not do. Close-ended funds are funds which lock in your money for 5 years or 3 years. You don't need to invest in closed-ended funds. So now you're left with only a few categories in equity. You've got your large and mid, you've got your flexi cap funds, you've got small cap funds. Within that, whatever has a low expense ratio, whatever has a long-term track record, a trusted fund manager who's been managing that fund for the last, hopefully 10 years, 15 years, you can pick any, honestly, maybe one fund from each category and one fund from each fund house. Chances are you'll have a great portfolio that will compound your wealth quite well.
That was a very good answer, but I think a lot of people will come back and ask for specific funds. People always want a very exact answer. Viraj, another question that we usually get a lot is, okay, I've been investing in mutual funds. At what point should I start looking at a PMS?
So just for our viewers, right, PMS is what we're talking about is a portfolio management service, wherein SEBI has clearly mentioned that 50 lakhs is the base minimum amount for you to invest in a PMS, correct? Now, I would suggest to our viewers, you have to look at it from two perspectives. Point number A, that you have, as you said, a equity mutual fund portfolio of 10 odd crores, 20 odd crores, 30 odd crores, and so on and so forth, right? For them to invest in a PMS does make more sense, very honestly, because PMS fundamentally are more riskier than a mutual fund. Let's say a mutual fund will have, the strategies are the same. They're bullish on the certain stocks and then they kind of buy that. But in a PMS, it's generally 10 to 15 stocks, and in a mutual fund, it's around 40, 45 stocks. So fundamentally, on that 50 lakh worth of your money, PMSs are slightly riskier than a mutual fund. But once you've laid that strong foundation for yourself, right, with a good mutual fund portfolio, with less volatility overall, then you can do a PMS absolutely no problem at all. And for someone who's just starting out, maybe chalo, I have 50 lakhs today, I have two options, या तो मैं mutual fund का portfolio बनाऊँ या तो मैं एक PMS में डाल दूँ. Fundamentally, it won't matter as much because you're still buying those same stocks. But the idea is you're betting on one fund manager completely with your entire net worth. So the idea is to build that strong foundation earlier, make that money with your mutual funds and everything. Eventually, it's all equity, right? Both are, if markets do well, both are going to do well. But I would still recommend people to make that mutual fund portfolio. And
But still, if you had to pick a number on when to do the first 50 lakhs in a PMS,
I personally believe for someone who's just starting out, right, first time entering into an equity market, until and unless you have 5 to 7 crores worth of mutual fund portfolio,
You should
equity
not do a
mutual funds,
PMS.
you should refrain, because that's, after that, if you do, it's only 10% or 8% of your net worth, and then it's still okay.
Because end of the day, if you put 50 lakhs into a fund, it's 50 lakhs into a single product.
Correct.
So you have to take the call of how much exposure you want in the portfolio in a single product.
I would disagree to that a little bit, but generally maybe my number could be smaller. But
Whatever,
it's okay,
but you should have that first base at least.
of
mutual funds.
Basically, let's just say that it's better to start with mutual funds
Correct.
and then go into a PMS.
So it's a progression, right?
Yeah.
In equity, you have your AIFs, mutual funds, everything, right? So
Correct.
mutual funds, you do some stocks, you do some PMSs,
Yeah.
do some AIFs, and then build a portfolio.
And of course, people forget there's a great category in mutual funds called focused funds. Which
Correct.
is basically like
Which
a
operates
quasi
like a PMS.
PMS, right?
Less than
number
30
of-
stocks.
Less than 30 stocks, yeah. So
Eventually, डालना तो सबको NSE के shares में, so it's okay.
thank you for listening. Those were the questions for today. Please do send more questions on this video if you're watching it and you have any questions you would like us to answer. Put it in the comment section. That would be really helpful. And also, please do subscribe, share with your friends. We hope you're liking the content. Thank you so much for coming back. We'll see you next week.